Good morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. Well, let's take a look at the equity markets. Well, the equity markets, here's the key. It depends what your time frame is. You need to know your time frame. And what I refer to that is, if we take the long-term trend, the equity markets are still in an uptrend. If we take a look at the short-term trend, equity markets are correcting. And we take a look at the medium-term trend, the equity markets are in range. So let me tell you what I'm talking about. So basically the markets hit highs in about January, late January, and then they hit their first low February 9th, which they rebounded very good from that spot. And the Russell 2000 and the NASDAQ composite were doing quite well. In fact, they both tried to retake their January highs and failed. However, they traded most of that time above their 50-day moving average. However, this last week, they fell below their 50-day moving average, putting it in a short-term kind of correction, because many good things don't happen when markets are below their 50-day moving averages. Now, those were the strongest indexes acting so well. So if we take a look at S&P 500, it's had a hard time. It also rebounded on February 9th. However, it met resistance and pretty much was just living right on that 50-day moving average. And then also last week, early in the week, fell below its 50-day moving average. And Friday closed all the way down to its 200-day moving average. Now we're having a pretty strong bounce, and this is what I'm talking about, why we're in a range. We're just stuck in this range between the January highs and the February 9th lows. And we need to get out of this range so we can say that a trend is continuing either to the upside, or if we break down below the February 9th lows and stay down there, then we may be turning the trend more into downtrend. Now if we take a look at the Dow also below its 50-day moving average, and that's persisted for a few weeks now. Still closed slightly above its 200-day moving average and is having a pretty good bounce. So again, you're range bound. Now, particularly NYSE, which is a much broader range, it's about 1,900 stocks. The NYSE index is below its 200-day moving average, so that's not a good sign at all. So, however, even though its longer-term trend is still up, shorter and medium-term trend, that's a downtrend. So what's a trader to do? Well, as I started out this segment, the most important thing is you need to know your time frame. If you're a long-term trader, you can sit in your trades until the lows are taken out and telling you that no, this uptrend is turning into a downtrend. And I'm specifically talking about the February 9th lows. I'm talking about a persistence below those levels because they may undercut them and bounce. Now, if you're a short-term trader, you're probably looking, not to be in any trades at this point, even though we're getting a bounce here, because in the short term, the market's to the downside. And your medium-term trader, you got your work cut out for you because it's a little bit of a chop fest as we move sideways until we can make a decisive break above the January highs or below the February 9th lows. And that's why I always say is let price and volume be your guide. Fundamentally, the economy is very sound. From a contrarian view, the psychological indicators are telling us the selling may be overdone. Sentiment is extremely negative. However, let price and volume be your guide. Have a great trading week. This is George Kachuk, RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago.